And our focus is on how different financial actors perceive the relative risks of oil, gas, and renewables in the post-COVID world. I think our members rarely get insights into thinking in the world of finance.
I mean, they've really been underperforming for about 15 years. And even when the oil price was high before 2015, the returns shareholders had been getting from oil and gas company shares were pretty disappointing. Partly because there was an element of value shifting towards producing countries, which may or may not be a good thing, partly because so many projects were late and over budget. Now, when we add to that COVID, I think what we really see is the gearing also that we see over and above any transition away from oil and gas. We see the gearing to economic growth. And certainly if we look at forecasts, real world forecasts, or indeed Valerie's scenarios, you're looking at very significant falls in demand.
We run with the assumptions, and I saw Chatham House 2 scenarios, and we definitely share the fact that one of the main factors that will affect the pace of the recovery is the coordination or lack of coordination between countries in terms of their management of the crisis, of the management of the crisis, health-wise, economy-wise, and financially as well. Now, one issue that I'm also facing is, and I've been saying that since March, is that don't trust the economists, simply because the economists are not used to model pandemics like acts of war or natural disasters, where you have a complete, I mean, not a complete, but at least a simultaneous destruction of productive capacity in the economy and in the energy sector at the same time.
We have one question already from Fahad Alidi, who says, for most discussions on renewable energy, we start the conversation with how competitive renewable energy is today, yet we still ask for significant public funding incentives and support. How do we reconcile these two things?
Renewable energy is already cost competitive without subsidy. It's actually 2/3 of the planet, and by 2030 that will be universal. I said 80% earlier, but I meant 2/3. And if I give you statistics from recent auctions in markets where we operate, I think you'll agree it's just low cost energy.
Now, you might have heard that already. Kenya recently has joined the League of Nations who are producing oil. And just on the eve of COVID-19, our main oil operator in Kenya, which is Talo Oil, has been trying to scale down its activities because they already had some other problems with them. Now, COVID-19 has further compounded this. And I'm really glad that now we're having a conversation about how then can we be able to tap into the other renewable energy. Now, Turkana County in Kenya is endowed with a lot of solar energy. And as you can see already on my left side, there's a lot of sun rays. So the question I have for the panelists is, what financing opportunities then exist for a county like us to tap into to ensure that we now, of course, in response to COVID-19, we are able to exploit more on this solar energy that we have in abundance with us?
And actually, I think the Turkana wind farm is a great example because it's been financed by a great large group of development financed institutions. And actually, for a well-structured project, there is plenty of debt and equity available. And the challenge is really, the clear framework and the well-structured project rather than the availability of financing.